silver didn't just fall, it snapped. In less than 48 hours, the market went from a moonshot high near $122 an ounce to the mid-80s. That's roughly a $40 air pocket, one of the most violent corrections silver has seen since the modern era learned to price leverage. And here's the part most people miss. This wasn't one story. It was two giant catalysts hitting at the same time, and then a third hammer that forced everyone to react at once. So today we're going to do a clean breakdown, no drama, no tribal narratives, just mechanics. What changed, who got forced, and why the move felt like gravity turned on overnight. First, picture what the market looked like at the top. On Thursday, when price kissed that 122 level, you could feel the psychology change. Not, this is getting expensive, but this is confirmation. People start talking in round numbers. Targets get shouted instead of measured, and the most dangerous sentence in a parabolic move appears, it can't go down because everyone wants it. Then Friday arrives, and the market reminds everyone what leverage really means. The spot quote starts slipping. A few percent turns into 10, 10 turns into 20. By the close, the tape is printing around 84.70, give or take depending on venue, while social feeds are still arguing about what the real price should be. That gap between expectation and reality is where panic is born. In a liquidation event, the first sellers are the cautious ones. The second sellers are the rules. Stop losses, margin models, risk limits, liquidation engines, systems that do not feel emotion and do not care about the story. They just reduce exposure. That's why the decline felt instantaneous. It wasn't a debate. It was a chain reaction. When silver is running parabolic, the trade stops being silver the metal and becomes silver the position. It's not bars in a vault. It's futures, perpetuals, options, and leveraged longs stacked on top of each other. The crowd is confident, the stops are tight, and the margin is thin. That's fine, until something shifts the price of money. Catalyst A, the new hawk shock. Over the weekend, expectations hardened around a more inflation-focused, strong currency direction at the central bank. You don't need a speech to feel that shift. You see it in the tape. Yields jumped, the dollar caught a bid, and the market suddenly repriced the idea that rates might stay higher for longer than yesterday's consensus. That matters for silver for a simple reason. Silver is often held as the opposite of tight money. When traders are positioned for easier policy, cheaper dollars, lower real rates, more liquidity, anything that hints at the reverse forces them to unwind fast. A stronger dollar doesn't just make metals go down, as a slogan, it changes collateral math. If your long silver position is funded with borrowed dollars and the cost of dollars rises, your trade gets more expensive at the same time your asset is dropping. That's a double hit. Now add leverage. In the last day or two, estimates suggest tens of millions of dollars in long positions were liquidated across major venues. One high-profile leveraged account on a large on-chain perp platform reportedly lost over $18 million in minutes when the cascade started. Whether you follow that specific story or not, the pattern is undeniable. Once liquidation engines turn on, they don't negotiate, they sell. And forced selling doesn't care about your thesis. It only cares about margins. Now let's zoom in on Catalyst A with one key idea. Expectation changes move faster than data. When a market believes the next policy regime will be tighter, it doesn't wait for meetings. It adjusts immediately. A near 1% jump in the dollar index is not a headline. It's a signal that global portfolios are shifting their hedges and their funding assumptions in real time. Picture a trader who bought silver because the dollar is going to weaken. That trader isn't necessarily wrong in the long run, but when the short-term tape screams stronger dollar, higher yields, their risk manager doesn't ask about the long run. They ask one question: how much can we lose today? So positions that were built on a soft money narrative get dumped together. Not because everyone changed their mind about silver, but because their time horizon got destroyed. And that's where Japan enters like a trapdoor. A lot of macro leverage is interconnected. If you're long silver, you might also be short the yen, long equities, long high yield credit. Different expressions of the same liquidity bet. When Japanese yields jump, two things often happen at once. The yen strengthens and global rates get pulled upward. That squeezes both sides of the leverage. Your funding costs rise and your collateral assets fall. Now imagine being a fund that borrowed cheap, deployed into fast trades, and suddenly faces a world where the yen is moving against you and the margin clerk is calling. You sell the position that's easiest to sell. In that moment, silver isn't a sacred metal. It's a liquid line item. That's the carry trade unwind in one sentence. The funding currency becomes a weapon. Catalyst B, Japan, and the liquidity vacuum. Here's the second catalyst, and it's the one most retail traders never think about because it doesn't sound like silver news. It's the plumbing of global liquidity. Specifically, what happens when Japan's bond market gets unstable and the yen strengthens quickly. For years, one of the biggest funding sources for global risk positions has been cheap yen. The basic idea is simple. Borrow in a low-yield currency, convert into higher return assets, and ride the spread. That's the carry trade. When it works, it feels like free oxygen. But when Japanese yields rise and the yen strengthens, that oxygen gets pulled out of the room. Your funding currency moves against you, your hedge breaks, and your broker starts calling. Now take that mechanism and apply it to a crowded silver long. If a hedge fund is long silver with leverage, and it's funded, directly or indirectly, through yen-linked financing, a sudden yen move can force liquidation even if nothing changed about silver supply. This is how liquidity crises travel, not through headlines, but through balance sheets. Reports over the weekend pointed to efforts to stabilize currency moves as the yen tried to swing too far, too fast. At the same time, a sharp move in Japanese government bond yields rippled across global rates. When global yields spike together, investors don't politely rebalance. They de-risk, and de-risking means selling what you can, not what you want. Silver, high beta, heavily levered, crowded at the top, becomes the first thing to hit the bid. So now you have two forces pushing in the same direction: tighter money expectations and a funding squeeze that drains liquidity from speculative positions. That combination is how you turn a correction into a waterfall. Then came the final blow. Catalyst C. Margin hikes that turned fear into action. Late in the week, the futures exchange raised maintenance margins on silver contracts. Reports put the jump around 15% from roughly 11%. If you've never traded futures, here's what that means in plain English. Overnight, the market demanded more cash from anyone holding a leveraged position. Not soon, not when you feel like it, now. So every small trader, every over-levered fund, and every "I'll add on the dip" account had the same problem at the same time: produce cash or reduce risk. In a calm market, some people can meet the call. In a falling market, most can't, because their collateral is shrinking while the requirement is rising, so they sell. That's why margin hikes often look like someone kicked the stairs out from under the crowd. They don't create the weakness, but they expose it instantly. And once the forced sellers start, price doesn't move in straight lines. It moves in gaps. Stops trigger liquidations. Liquidations trigger more selling. Selling triggers volatility. Volatility triggers wider risk limits. Wider limits trigger more selling. A feedback loop. This is also why you can see a giant drop in paper price, even while physical stories feel tight. Paper sets the headline price. Leverage sets the speed. Liquidity sets the damage. So, is Japan to blame? Or is the new hawk to blame? If you want the honest framework, it's not either or. The repricing of money was the narrative shock that flipped sentiment. The yen and rate squeeze was the liquidity shock that forced liquidation. The margin hike was the mechanical shock that accelerated the cascade. 3 different engines, one direction. Now the most useful question isn't who did this. It's what should I watch so I'm not surprised again? Here's your checklist for the next few sessions. Watch the dollar index and front-end yields. If they keep pressing higher, metals stay under pressure. Watch Japanese yields and USD JPY behavior. If the yen strengthens quickly again, carry positions across markets can unwind further. Watch exchange margin updates and volatility controls. When margins rise into weakness, it signals risk managers are in control, not traders. And watch the spread between paper headlines and real-world availability, premiums, delivery delays, and the tone of the physical market. That's where stress hides first. Silver can absolutely recover after a liquidation event. But the recovery won't start with hope. It starts when forced selling ends. So I'll leave you with a simple question. Which catalyst mattered more in your view? The money repricing, the Japan liquidity squeeze, or the margin hammer? Drop one word in the comments: hawk, Japan, or margin. And if you want a follow-up breakdown on what forced selling is over, looks like in the data, say over, and I'll map the signals.